Ellie, I just realized it says March, not April.
No,
Awesome. Hey, welcome
we need our marketing
everybody
team to
to,
proofread it.
yeah. Welcome everybody to our April 2025 webinar, not March. Our apologies on that. Maybe where I'm at up here in Illinois, it's just been kind of a cold spring, so I'm still thinking it's March, but my apologies on that. It is April. You're not in a time warp. We are here in April, so let's just give this a few more. I think just give it like 30 seconds here, and we'll get going. All right, let's roll. Okay, again, this is the April 25 webinar, not March. We'll correct that. Sorry about that. My name is Scott Ebley. I'm director of the strategic solutions team here at Box. With me today is Allison Black. She is the manager of the pricing desk and strategic solutions team. And today we're gonna do an energy market update and a deep dive into strategic products. But to start out, Ellie's gonna take it away here, and we're gonna be talking about Box here a little bit, as we always do. So take it away, Ellie.
Awesome. Thank you, Scott. And thank you, everybody, for joining us on our webinar this morning, our April webinar. Just to introduce Box, in case you don't partner with us yet, don't know who we are, maybe saw a spot on LinkedIn and said, yeah, I want to learn a little bit about that. We just want to take the opportunity to formally introduce ourselves. We are Broker Online Exchange, and we are your ultimate commercial energy brokering partner. We provide independent energy brokers and affiliates with access to all top electricity and natural gas suppliers, instant pricing, and cutting-edge software, all supported by industry experts. Box has become the largest network of energy agents, brokers, and consulting firms in North America. Our mission is to connect a variety of diverse energy partners so each can benefit from streamlined, efficient options in deregulated natural gas and electricity markets. You can see those markets and how you can scale your energy business nationally with the map that is currently up. You'll see that we have natural gas options available in green, natural gas and electricity options available in blue, and then you'll see a healthy amount of the Midwest, the West, and North Carolina that are all in this kind of gray, some with some strike throughs, things like that. Those are limited availability natural gas markets. Most of the, actually all of the lower 48 is deregulated when it comes to natural gas. It just depends on how big that customer is. Most of those customers have to be industrial, manufacturing, very large commercial customers to be able to shop. But some of these areas do have shopping programs. So if you have a customer that's in the manufacturing and industrial vertical, definitely let us know. Or if you're working in one of these states and would like to expand your operation, maybe you're local to Pennsylvania and would like to expand into Ohio or into New Jersey or into Maryland, those types of things, we have resources to support you, whether that is a dedicated account manager, a full online platform with tools and resources to help train you, a state-of-the-art system that we have built that's our own proprietary system. We've got lots of tools and resources, as well as our strategic team, which we'll touch on a little bit later. Talking about those resources, obviously one of our best assets is our supplier portfolio. We partner with every major energy supplier out there. You'll see some names that you recognize here on this sheet: NRG, AEP, Freepoint, Constellation. You'll also maybe see some names that maybe you're not as familiar with. If you guys don't work in Texas, maybe you don't know TXU. Or maybe you guys haven't met CPV yet. They are an awesome supplier that really specializes in PJM. They've been pretty flexible with lately with some creative products. So happy with them. With Champion, lots of names up here that you guys will recognize. But if you're looking to get more options, if you're looking to put different strategies, different products, different suppliers, increase your portfolio, and just really increase all of the options that you're able to offer your customer, we're able to help you do that. We are happy to provide resources. A lot of our executive management team prior to founding Box over a decade ago worked on the supplier side, have great relationships with management at all of these suppliers. All of these guys are people we consider our friends. So happy to put those resources and relationships to work with you as well. Then we also want to touch on our strategic team that's headed up mainly by Scott and myself, but we're really here to help with larger deals. Anything where you're in a competitive situation and you just need a little bit of an edge. We definitely have different strategies, different resources, different tools that we're able to allocate for different deal sizes, but in general, we want to talk to you guys. If you have a difficult sale, we can help you figure out a tailored sales strategy, developing a customized approach, and really designing a product, a strategy, and a contract around the customer rather than the other way around. We are looking at data-driven insights, whether that is leveraging our internal market analysis, our internal models, or whether we're looking at customer data and actually pulling different pieces together to get a more holistic view of how the customer is using their energy and how we can help them accomplish their goals. We also do have, and we've talked about it before, a reverse auction platform, and that really helps to optimize the transaction. So once we have done our analysis, once we have designed a product, once we understand exactly what it is that we're looking to transact on with and for this customer, we can utilize the reverse auction platform to make sure that they have absolutely the best rate on the market from the top suppliers who have agreed to their contract terms on the day that they want to transact. It's a great way to ensure transparency, to show your customer, look, all of the suppliers knew where everybody was, and to really make sure that the suppliers are shaving down and making sure that they can get into the competition. The suppliers want to win this business. I mentioned just in terms of our strategic sales and in terms of the reverse auction, but another piece that's huge here is contract negotiation. Like I said, we have extensive supplier experience and great relationships with these suppliers. We assist in these negotiations. We assist with writing some of these contracts to ensure that they perform optimally for the customer. Contracts are almost always written to benefit the party who writes it. These are supplier contracts. At a minimum, we want our customers to receive fair treatment. And so we have several contract drafts with several suppliers that we have negotiated in advance that have our own contract language. And we can talk you through those changes if you'd like, just in terms of things that we recommend, not just for one customer, but for every customer. But for your larger customers, whether it's larger credit exposure, higher risk to the supplier, it's a larger customer with more complex needs, whether that's coming from a product perspective or a billing perspective or both, we are happy to help with that. We're happy to lend our expertise, our time, anything that you need. Our mission, like I said, is to support the largest network of brokers in North America. So at the end of the day, we're here to help. We're here to help you. And we really, really enjoy providing seamless client support and proactive solutions throughout the term of the contract. So we will help design the product. We will help. We'll get on the phone and address any gaps. We'll have any education conversations. We really enjoy those. We like negotiating the contracts to ensure that our customers are receiving fair treatment. And we monitor those customers, particularly around some of the more strategic products that we sell, some of our more managed portfolio customers. We're really offering that end-to-end service from initial engagement all the way through post-sale support. Once you and your customer have this type of relationship with our team, this is something where we will continuously be providing support, whether that is market data or proactively looking at a renewal. If we're looking at, okay, when should we time out the next hedge and what should that look like? However your customer would like to manage their energy needs, and something that we're happy to help with. And we really enjoy having those long, really solid, long-term relationships where you have a product that performs well, a customer that's happy, and we, and we've, and we've created a good experience for the customer and for you, our partner. Scott, is there anything else we want to touch on the intro section, or
touch on it all, Allie.
into the
Touch it
market
all.
update?
Appreciate that. Yeah, thank you. Yeah, I mean, again, we're, I think, just to sum it all up, we're here to help you close deals. That's our #1 goal, and we aren't just here to provide pricing. We're not just here to even just to tell you like, hey, yeah, do try this product, try this. We couldn't really get down to sales strategy and figure this out. We look at all these as puzzles. Every deal here is a puzzle, and some of them are easy to solve, and some of them are harder. And we really have some passion and kind of solve those tough ones. So bring them our way. I will now go on the market update. And so to start out here, energy price update. This is natural gas, down quite a bit in the last month. All these markets are down quite a bit. A lot of fluff have been taken out. We'll look at the historical charts here in a second. But this is the monthly change, the yearly change. And this price here, this is the 2026 price. This is the next full calendar year. At Box, we do not like to look at the front month of the contract because no one is doing really 1 month deals. People are doing, on average term here is usually around 30 months. And if you're doing 30 months, 2026 is going to be a big part of that. But this is what, if we're gonna look at one price point, that's what we look at, 2026 calendar year strip. And we can see here, 411 down 32 cents in the last month, and see all their power markets have really come off as well. And some of these outer years are nearing 3-4 year lows, as we'll see here in a second. So yeah, take a look at this now. This is the NYMEX Henry Hub pricing. 2026 is in black, 2027 is in blue, and 2028 is in green. That's that full calendar year. This is how it's performed over the last 3 years. Those calendar strips you can see here then in 2028. And if we put it on 2029 and 2030, we'd be at lows right now, 3-year lows for those terms of those years. 2026 is still up pretty high, but a lot of that fluff has come out really because of the, we've had a kind of a U-turn here in the last month with 2 things. One is some tariff stuff, then action and economic stuff that we'll talk about here a little bit later, but also at the end, I think the last slide we'll talk about that. But also just in general, the weather is this spring has been relatively a little bit earlier across most of the country, where we've had some really nice healthy injections here so far, and it's kind of turned around that dire low levels of predictions about 1,500 we had in like early February, potentially hitting or below that. We ended up around 1,650, 1,700 in storage. Going into Texas prices now, similar sort of thing, although we are up though pretty high here still. We've had some market this come out. A lot of this pricing, despite where the LMPs are at, and we'll look at the LMPs next time here. This is the LMPs. We've averaged 47.66 for the last 3 years. And if you really take out that August period here, we'd actually be down August 23. We'd be actually down in below that. So really, in the past 12 months, we're close to like $30 here. Yet, despite power prices are up here, 50, 52, 53. And this is really, a lot of this is some stuff out here about data centers and all this stuff and coming online, and is there going to be generation to match it? And we're seeing extremely healthy on the generation side. And, actually the demand side could be overblown a little bit as far as how much data center growth is really actually going to come to fruition there. So we are hesitant on full hedging out there in those terms. Now look at New England, similar sort of thing. They get 2028, 29, 30. All those are kind of their 3-year lows. This market's come off quite a bit as well, and you can see here we have these Hawaiian LMPs here in the winter. We actually had a piece that we recently put out on at least I put in my LinkedIn. I'm not sure if we published it here at Box, but we put a piece together here on really on why winter prices are much higher when the basis gas here and the winter prices and natural gas is pretty interesting piece. I'll make sure that gets out to everybody. But yeah, you see here again, high index prices in the winter, rest of the year, it's pretty tame. Now just going into PJM, we are seeing here again, relatively speaking, this big peak up as we see in Malal. If we look at this levels up here, we hit up $65 here back last spring, and that was for 2028. And now it's completely gone flipped the other way, and now we're been hitting on 46, 48 area here. Not on lows, but getting pretty close. If you look at Ohio, you look at Illinois, ComEd, we are in lows in these areas. It's really amazing, but in this was euphoric. Everybody got long here, and these hedge funds started like, let's go buy power. Never done it before, but hey, let's go buy it. They bought it, and they started like having to puke these out a little bit. We had a little resurgence here back in the winter, but a lot of this have come off now. This is right around the period where, DeepSeek came out, and we've been publishing out some stuff out here for a while here about how, again, we think this is they're overemphasizing how much load growth is going to be here in PJM, and the market's kind of like has to continue to spit it out because they don't like these positions, but also now really just because some other more economic stuff as well. And here's a West Hub market. And PJM West Hub is a good proxy for anything kind of Pennsylvania and over in PJM. So that's Maryland, DC, New Jersey. Just kind of like look at in Pennsylvania. It's a good indicator for that, and also a little bit of Ohio as well. But this is 3-year average in 46.69. So we're kind of like trading around those levels there. Relatively better values now than we've been seeing where gas prices at. So it's really solid, but again, pretty tame. It's been pretty tame here as well. And then now I just want to show this historical chart too. This is Illinois, and you see here, yes, we are down. Actually, again, this is wholesale ATC price, but we're down here in below 35. I wasn't sure if we're gonna ever get there again, but look at this variation here. 54 on April 15, 24, and now we're down to 33. So $21 difference. And this isn't just because the gas price dropped. Gas price alone, this would be really about a $6 or $7 move. This is just, again, it's kind of like taking the fluff out. We actually see a lot of value here on these back years, and we're recommending in some of our customers, gets a little fancy strategic wise, and Ellie will be going into this kind of things in a few minutes. But we're actually doing some stuff where we're like hedging less for our customers here and hedging 75 to 100% in the back, just because we think this is overpriced still, but this is a really good value. And data center growth and all that. And in ComEd, just want everyone to know too, ComEd is actually the number 3. So Chicago area is number 3 in data centers right now, in the capacity of data centers in the world, and it's growing. From all my contacts I have out here, it's still going to grow. It's number 1 is of course the Virginia area, across the river, across the Potomac from DC, and number 2 is a city in China, and number 3 is Chicago, and then this falls into a bunch of other cities around the world, including China. But yeah, I mean, it's definitely a big powerhouse. We see growth there, and growth outstripping some of the supply. We think there's incredible value out here. I know we've talked about, and again, some people on the call here do a lot of price compare stuff. Those price compare rates in ComEd are going up in June. They will be going up because of capacity prices. So you're going to get some relief here, and pricing's come down. You should be able to start showing it. And the customers that are over 100 megawatts, it may have been on real-time rate for a while. It's definitely a good point to show them that this is there. So now let's go to this PJM annual peak load growth 2025. This is the number we are expecting to hit is 154. And then we're going to be hitting up, this is the projection, the 183 to 209, 220. I think you pretty much about 10,000 off of each of these at least, especially 2030. I think that's more about where we're going to fall into. But I also want to put out there, this is what PJM is saying. And one more thing as we talk about it, because the peak load, we are going to actually have the PLCs are really important now because of capacity. I'll go on to the next slide. But we are going to be having CP notifications here. We developed these before at supplier levels, and they're really popular. And then we have suppliers have them and everything like that. We spent quite a bit of time the past month working on the framework for this, and we're excited to bring this out to you guys directly from Box. We'll be sending out stuff on this, but any customers that want to get alerts, they're going to basically be getting a daily thing showing a 5-7 day forecast and what the likelihood of that that's going to happen. So we're excited to be delivering that to everybody here. And so now let's just look at this. This is in June. I just want to remind everybody, this is going to be the percentage of capacity cost increase for customers. Most likely this is going to be things like capacity prices going from $2 to $20 a megawatt hour, $2.50 to 25, and this is important. We can get the budget impact. We've got the tools for that. Just contact our desk. But this is each of the. And by the way, this PDF is in the notes here. The handouts on the webpage. You can download this PDF if you want this chart here specifically. But this is important stuff. If you haven't already, please contact your customers so they're not shocked in the bill. Last thing you want to be proactive rather than reactive, especially in this situation, especially when the bills go up this much. We've been, telling you guys, telling everybody that this is happening, this is going on. Very important to have this, and it's going to continue on. We just got word yesterday that the capacity collars got approved by FERC. And so these kind of price levels are going to be here probably for the next 2 auctions, at least around this range. So yeah, start having those conversations. And one more thing. Then this is why CP notifications are extremely important this summer, is because what happens this summer is going to be for the next planning year. The next planning year is going to be around these same levels. So a customer, as an example, that's paying averaging around $24 a megawatt hour for capacity, and they're using 3,000 megawatt hours a year. That's $75,000 a year in capacity costs. If you can just shave 20% off those CP notifications, that's going to save the customer $15,000 a year. That's huge. That's just for like cutting power down a little bit every hour. And then if you really want demand response costs, we can get you in there. If you can cut up to 300, 400 kW, a customer can. Again, that's cost checks being sent right out to them because then they're participating in the capacity market. So now just going to some fundamental slides here. This is natural gas. We are now at 1846. And this is where we were we hit a low at 1698 in the 10th week, which is mid-March. Typically this would continue going down a couple more weeks, but it didn't. It went up. We had some big injections, and we're talking maybe having some early triple digit numbers here in the next few weeks. But yeah, this kind of bounced right back. We thought we'd finish right here in the middle, I'd say back in like early February, and it actually bounced around because of the weather, and kind of now it's hitting up near, kind of these more 5-year those levels. Early projections are we're going to finish up right around here on injections in normal winter, in going to the fall, and that's much healthier than we're talking right around here back a few, 6 weeks ago. that we'd finish right around these kind of levels, 5-year lows. Believe it or not, that 200-300 BCF makes it a nice, much healthier cushion for us. So that's good there. Next chart. Natural gas, this is natural gas demand growth by 2030. Unlike the demand chart for PJM and ERCOT as well, where we're kind of like, I'm not sure this can work out. This is happening. These LNG exports are happening. Dun, dun, dun. And it's probably going to fall more in here. I'm actually kind of like, I think we're going to cap here how much we'll actually export. And I think that's going to be around 25 to 26 or so, and those are already approved, and that's what this medium case scenario is here. But this is relatively massive here. This is we're going to hit around like 21 BCF of new natural gas demand growth in the next 5 years, barring major recessions. But yeah, this is probably going to be it. Even a low case scenario, we're hitting around 15. So big question: natural gas, are we going to hit those levels? Here's natural gas production. We're at about 105.9 now in April. Yes, we're getting there. We're getting there. We're getting there. A little higher. But you know, this has been relatively kind of stagnant-ish, and a lot of this is we're producing out with a lot more flexibility with the producers. We've said it before. We think there's about a floor of about 350 in the strip gases. We're kind of hitting some of those levels in the back years right now. I just don't think that that's kind of new level where producers are willing to produce. This isn't the 2010s where drillers are just drilling and going at it because they've already got sunk in the ground. They wanted to keep drilling and going, and they would produce no matter if they made money or not. It's a different ballgame now. And with that, you see here in the rig count, we're at 98 here, and this was in May of 23 was 160. So we've kind of just been hanging around here, not really moving around all that much. Had that big drop here at the end of the month, and there's some things here. This is about drilling here. Is that one of the things these tariffs are? Is some of the material, a lot of materials that they use are increasing, so the cost to produce is going higher. And the other part of this too, the fastest growing field is in Texas, in the Permian Basin. That's really where a lot of this growth in natural gas production, if you go back to the other slide, is coming from. And with oil prices continuing to go down, all that gas that gets produced is called associated gas. It's just extra gas that comes with the oil. And so for a lot of these producers, if crude oil goes down, they're not going to produce as much, they're not going to grow production as much in the Permian Basin. And with that, the associated gas is going to come out. So low oil prices is actually almost bullish for a bullish signal for natural gas prices, because not as much production comes out. That's something a lot of people don't know that fact. Going back to this, there's also a lot of drilled uncompleted wells already been drilled, already there. They can just pop on in a second. It's inventory. We're going to ripping through that inventory, and that's why production has been going up. My production is staying stable. Another fun fact: decline rate of these wells are huge in the first year. Yes, they don't produce as much in the second year as they did the first year, and the third year as the second year. So with that, they have to keep drilling just to keep it going. It's almost kind of like a Ponzi scheme in a way, right? Cash keep coming in to keep everything afloat and pay off people. But can you watch out that? Finally, last slide. Had a lot of questions about tariffs and what the effect is. I talked about the drilling side of it. Yes, Canadian, maybe a little bit less Canadian gas coming in, some prices on that. It's still profitable to send it in. The power stuff between Ontario, that was, and power come from Canada, that was not going to have a huge effect. what's going to have an effect on the market is a recession. Demand goes down, especially if a recession goes worldwide, and then maybe even LNG demand goes lower, and that's going to bring down prices. And that's what we saw here. I'd say half the price issue was weather, another half was the tariffs that were announced. The biggest chart. This is kind of my chart of the month. Every month I always have a chart of the month. This is amazing. This is really a striking thing here. We are now at, this is consumer confidence index. This is the main thing that Wall Street looks at. This is a leading indicator. A lagging indicator would be something like unemployment because it's already happened. This is kind of like showing kind of where the confidence is and the uncertainty. And I've seen some business uncertainty indexes too that are off the charts as well. But this is what is fearsome. This is what, there's a lot of uncertainty. People don't know what's going on. The confidence is waning. They don't spend. Our economy is 2/3 of it is GDP, is consumer spending. So if the consumer confidence is low, they're not going to spend as much, right? They're not going to go take vacations. We've seen all the airlines talking about, how they're cutting their earnings forecast because they're seeing much less people taking vacations. We've seen it from Marriott and their announcements of much less leisure travel. We've seen it from, people buying any other sort of a kind of discretionary item. It's kind of disappearing. But we are at levels here just above the historical low of June 2022 during the heart of COVID. We're actually lower than we were in the Great Recession. And it's just plummeted. This is something to keep an eye on. This is why, we truly believe, again, just going into hedging strategies and making sure we get the best prices out there and have a good strategy going with it. But just also want to put that out there. These are good things to bring up if you are competitive on deals as well with another supplier. And I said it before, I'll say it again. You don't have to be you just have to show something different sometimes to get their attention and get their trust. Because everyone else in this industry is buy now, buy now, buy now, buy now, buy now. Markets, the lowest is going to be, you got to buy now, it's going to go higher, going to go higher, going to go higher. Everybody talks like that. That's what everybody sells. And maybe sometimes it's good to just show them like, hey, maybe we just wait a little bit. And especially their contract's not due for 6 months or something. And it's a good way to differentiate yourself from a competitor. If you're competitive on a deal, is say that and just say, hey, we have independent research here that's showing this. Suppliers aren't going to tell you that. They're going to tell you to buy because they have generation, and then our brokers can tell you to buy because he wants to close a deal. Maybe just tell them to wait a few months, especially if it's competitive. You might, catch him where he's like, wow, no one's really said that to me before. We just appreciate it. So I'll stop there. I'm gonna let Ali kick off. I do want to let everybody know that we have all these charts now are being sent. A lot of these charts are being sent now in a weekly report. And we also have an historical charts out there as well. I send it out to the team here internally. They are able to send out to anybody else that wants it. So just talk to them and they'll put you on a list and get them sent to you. And we also can do these charts, any historical charts, any of this stuff, index charts. We can drill down the PPLs and stuff like that. Just ask us. A lot of this information is now on our MSC as well. Although these charts can get a little fancier and much more customer presentation friendly. But I want to put it at that, and that's it. We will now let Ali take away the deep dive into strategic products. Go ahead, Ali.
Awesome. Thank you, Scott. Quite the market update. I love those new charts, and I love that we're running it off of something where we can animate a little bit. It's just it's a lot more fun. So forgive us for our typo at the top of the webinar, but I hope that the updated charts are also worth it for us. I wanted to talk and do a deep dive into our strategic product suite. We do this type of webinar and have this type of discussion every once in a while. We really love having these conversations with our broker partners who maybe have only sold for one supplier, maybe have only sold in one market, maybe have only sold fixed all-in products before. There's a whole world out there that we are happy to help you explore along with your customers. A lot of this tends to get into kind of the weeds or the nitty gritty, but this is why we're here. There is, I think, we can definitely still have the conversation of, hey, let's switch your energy supply away from the local utility. Let's find a nice low fixed rate and give you some budgetary certainty. Maybe there's some savings. That's a pretty simple conversation, right? And it's not necessarily talking about capacity values in PJM or whether it's better to pass something through in PPL versus PECO. It's not talking about the types of premiums that are associated with New York capacity or with New England power prices overall. And those are some of the conversations that we really like to get into on a per customer level. So the first piece that I wanted to talk about today, just going over our strategic product suite, is really talking about how many costs on the supply side aren't necessarily energy supply, aren't necessarily generation. And this is starting to be the case even more so in ERCOT than this chart shows. I think this chart is from a couple of years ago, the ERCOT chart or the ERCOT values. As you guys know, we are starting to see additional ancillaries in ERCOT, whether that's ECRS, market securitization, some uplift, some RMR. Obviously, all of these areas are increasing their RPS share substantially over the next few years as well. So these charts will continue to change. They will continue to change as energy prices change, but they will also continue to change as more of these I like to call them non-energy or regulated components also start to change. And these are important. You can see here in our PJM chart, I think that, again, this is accounting for our old capacity values. So that a portion of capacity would grow as well, that dark piece, So just looking at this and looking at how much of a supply price or a quote unquote generation price actually doesn't necessarily have anything to do with generation. So the way that we talk about this, and we'll look at this a little bit on the next slide, is we will break it up into into those components and look at each component individually based on that market, that customer, how they're using their power, and what goals they have for the future year, 5 or 10. We are definitely, as Scott was talking about, we're being strategic in terms of our recommendations and really making a long-term plan in support of a long-term relationship with our customers. So essentially, the best thing to take from this first set of charts here is just that whenever we're getting into a market, if you need help, if you've only sold in ERCOT and you're not familiar with capacity markets, if you have only sold in Pennsylvania and like I said, want to move into Ohio, Ohio doesn't have a transmission component and works a little bit differently than Pennsylvania. If you want to be able to optimize some of those costs for larger customers and by capacity in bulk, things like that are items where we really are looking to get into the weeds with the customer, get creative in terms of the product structure that we look at, looking at each component individually and just making a decision as far as, okay, what is going to best serve this customer? How can we give them a cost that is fair, transparent, and helps them to accomplish their goals, whatever they may be. So getting a little bit more into the products that we can structure, we made this chart a little bit ago and I really like it. So if you guys are only familiar with fixed all-in products, I really highly encourage you take this, print it out, look at it, have it handy, start talking to your customers about other products, particularly as we have changes like we've had capacity prices come up in PJM over the last year and will hit and affect a lot of our customers in June, particularly as we have higher pricing levels in ERCOT, sustained higher pricing levels than most people are familiar with and know what to do with. We still have people who are asking for 3-cent all-in pricing in this world, and it's just like, guys, it's 2025, not 2015. I don't know, I don't know if we're going back. So with all of this pain, with all of these higher pricing levels, with this volatility and general uncertainty, it's a great opportunity for you to come in and be the expert, have the options. Yes, be able to have those tough conversations, but be able to hold your customer's hand while you do it and let them know that we have some options and we can structure something that's creative to help get them where they need to go. Maybe that is a fixed all-in price. And in this chart, you can see that that area is fixed. That's going to be your dark blue, just fixed and fixed throughout the term of the contract. Generally, a fixed all-in is going to take all of those supply components, whether it's capacity, transmission, RPS, some smaller ancillaries, of course, your broker fee, and it's going to apply that fixed price to all volumes. Essentially, what the supplier is doing is they are going out and they are taking a financial position in energy markets, in capacity markets, etc. And they are making a purchase on behalf of the customer. The customer then reimburses them over the term of the contract. But remember that these suppliers, they may be generating themselves, but it's not like they're actually funneling these specific electrons from an individual source. Even if they have generation assets and are selling generation into the market, what these suppliers are doing is they are making these purchases and they're packaging them together to benefit the customer. So this is a financial product that we're selling the customer. It's not necessarily a physical product unless we get into gas, but it's a different thing. Going a little bit more into it, fixed with bilateral adjustments. Some of you guys are probably familiar with bilateral adjustments. A lot of suppliers started putting this language into their agreements some 2-3 years ago whenever we did see some volatility around capacity and transmission. These are great products that can give your customer the same level of budgetary certainty that a fixed all-in product would, but they also give them some flexibility to pay closer to their actual cost when it comes to those regulated capacity and transmission components. I call those regulated costs because while yes, customers may be able to have some sort of control over that cost, and they may be able to hedge against it, these are costs that are, at the end of the day, calculated by the regional transmission organization or independent system operator, the grid operator that presides over that customer's area. So capacity and transmission, both along with RPS and ancillaries, is simply a formula that says, okay, we know how much capacity is going to cost. That's our cost of keeping generation online so that we have power availability. We have our transmission cost over the calendar period that we're looking at. And those values are then going to be multiplied by the customer's tag, that is again, RTO or ISO assigned. And that is going to be their entire obligation. That is going to give us their entire obligation. That's going to give us their cost. That cost is then broken down and distributed according to their overall consumption so that you get a nice unitized per kilowatt hour cost. With those capacity and transmission pieces, if when the customer gets updated tags or we get updated values for capacity for transmission in those areas, like we will get updated capacity values for the Cal 2026-2027 capacity year here, in the next 60-90 days, hopefully, no delays. We should be able to get those. And at that point, we'll be able to know, okay, so we understand now what our customers are going to be paying on this type of structure through May of 2026. We will then be able to calculate new values for our capacity going into 2026 and 2027. Another way of dealing with those components, capacity and transmission specifically, but you can always float them. And essentially all that means is that they're going to be passed through to the customer without markup. This is a great move if your customer is looking at any sort of peak load shaving, if they're looking at any sort of efficiency measures, if they're doing LED lighting retrofits, if they're looking at getting a new HVAC unit installed, or if they're installing any sort of on-site generation that can really materially impact their load and their demand. Looking at passing through some of those values, just have your customer pay cost. Supplier won't mark those up. There won't be any sort of risk premium associated with it. And because these are values where we do understand the values, we know the customer's existing tags, and we know the existing capacity values, we can provide the customer with relatively accurate estimates in order to give them a nice whole budget number that they can take to, to their superiors or to their stakeholders, whatever they need to do. And because they've passed it through, that when their tags start coming down, when their demand values start coming down, the customer can realize those costs closer to real time rather than renegotiating their entire agreement to do it. We also have some pieces in here, energy only, index adder, full pass-through, which have either floating components or components that can be fixed and floating. That's a little bit confusing, so let's get into it. If we're looking at an energy only product, generally that means that you're floating everything that isn't energy. So you can fix losses in there, we generally don't, and you can fix energy in whole or part. So you can fix 100% of your energy, and you can set that energy to follow your load and be shaped to your load. We can set 100% swing at that energy level so that it's, regardless of how much you use or how much you don't, that you don't necessarily have settlement risk there. So looking at energy only, you can fix in whole or part, you can fix as a percentage load following, or we can do something with a hybrid, a block and index product that's really more quantity based, not so much shaped to the load, but have more price transparency and potentially just a better, flatter price without those risk premiums shaping premiums. Looking at index adders and more pass-throughs, these are products that can be fixed, they can be floating, or maybe we have a creative option where we're doing a partial fix. Whether that's something that is capacity, doing something that's a little bit more creative, or really going in and getting into the really nitty-gritty with ancillaries and looking at, okay, we're going to pass through ARR, but we're going to lock down, a different component. And then we have our full pass-through index adder, where, as you can see down at the bottom, your broker fee is always going to be fixed. That's always going to be a fixed value. That's something that we decide in advance, or that you decide in advance, something that we structure to apply to all volumes. And so that is always going to be fixed. But if you're not familiar with these products, if you're not familiar with these component treatments, please reach out to your account manager. Let's have a conversation about these products and which customers they could be good for. I will say that with these products, these are part of our larger strategic suite. So the whole of these products, all 6 that you see up top of the chart there, those are going to be products that are available to custom size customers. So those are going to be customers that are 1 million kilowatt hours and up, or 100,000 therms and up. If we start looking at some sort of creative natural gas structure, you can do a block and index or like hybrid style gas product that can mirror these power products. Power's a little bit more complicated, just as much, but we can help you get there. And being able to fall back from selling your customer a fixed all-in, a budgetary certainty. Yes, especially in our in the current economy, a lot of customers are looking for budgetary certainty and are looking for safety and for risk management where they can get it. But if we have customers who have bigger backbones, who are not used to these higher pricing levels, who are either interested in taking on a little bit of risk in trade for being able to get some of that downside benefit, or if we have customers that have set goals over the next 5-10 years, where we're looking at efficiency, we're looking at our costs, we're looking at build outs, we're looking at moves, we're really fundamentally growing and altering the way that we use power or natural gas at our business. This is the type of design that we're looking at. These are the types of products that we should look at for them, and we should really get into, okay, what would serve them best, and not just for the next, for the next 12 months, but for the next 60. Some of the opportunities, the best opportunities that we see for purchasing are 2 and 3 and 5 years out. And we're looking at that all the time. Again, this is what we do. So looking at these customers, looking at their historical usage, looking at their load, and just having these higher level strategic discussions with our supplier partners who are really interested in winning this business and in winning not just the deal, but the customer relationship is really where we want to be. If you have questions about, again, these components, the treatments, the market, reach out to your account manager. Let's have a conversation about who this might be good for and how to sell it. The last piece we want to look at here, actually, I don't know if it's.
Yeah, I just want to.
Yeah, go for it.
One thing real quick. The right now. When you're asking, when we're getting fixed from suppliers, this is not. It's typically more of that fix with collateral adjustments. It's not. It's not really. And some of those areas can be shaded in there. I think that's something a lot of people need to understand. Fixed does not mean fixed. Typically, you have to negotiate that. The standard is, and it's going to be more expensive than the fixed bilateral adjustments because they're going to be putting risk premiums in there. And it's usually much more expensive. It's not worth it. So most customers, most of them fix bilateral adjustments, and sometimes, not all the time, but sometimes those are fixed with unilateral adjustments, and that means those adjustments are going one way, and it's going to be, like you're speaking, a third to 40% of the market of suppliers. That's what it's going to be, more of a unilateral adjustments. We try to negotiate that language in sometimes we can. But yeah, I just want to put that out there. So we'll go to the next slide. Thanks.
Yeah. Oh, no, absolutely. And I think we do talk about this a little bit on this slide too. That's point number 2. Buyer beware. Even if a component is listed as fixed, suppliers may still be able to make adjustments midterm depending on the contract language. We do have contracts, and I was reading one from last year that was very specific with respect to PJM capacity. They said this will not change through the term of the contract. That's it. Which, great, as long as we've got that language in there, we're safe, we're protected. But like Scott was saying, a lot of fixed contracts will be listed as fixed all in, but they will still have items like change in law. They will still have bilateral adjustments, or they may just have a adaptable or adjustable component listed. So be careful. Oftentimes, products with those adjustments, really the reason why suppliers are coming through with products with adaptable or products with true ups, products with adjustments, is because they don't want to sell the customer, or maybe they're not totally comfortable setting the premium around capacity transmission, some of these other components. But at the end of the day, the other thing is that they don't want the customer to be stuck overpaying. And they're looking at it saying, hey, yes, we could fix it, but if I put this premium on it, then, I mean, the customer is going to overpay. There's a customer of one of our senior account managers that I reference all the time now that was over in New York, so different situation, but the cost of fixing capacity for this customer was going to be about $32 a megawatt hour. And whenever we looked at settlement values for capacity for that specific customer, their total average settlement was $7 or $8. So there's some $20 or so of just premium just sitting in that price around just the capacity component. So looking at it and making sure, okay, yes, we can fix it, or fix it, or we can try to fix it throughout the term of the agreement, but does that really serve the customer? And even if that is what the customer is asking for, can we have a conversation to tell them that what they're asking for may not actually be in their best interest, and maybe recommendation towards a product treatment that is? So understanding which components are included in the contract price and which are excluded is critical. Understanding the mechanisms by which the suppliers may be able to make midterm adjustments and when or if you should expect those throughout the contract term is also very important, just in terms of setting expectations with your customers. And again, guys, adjustments, pass-throughs, those types of things, let's not be afraid of it. They're not necessarily bad things. Have those conversations with your customers where you're telling them, listen, by passing these products through or by allowing the supplier to adjust them, you're avoiding premiums. You're avoiding paying more than you should. Is it really, is it really worth a fixed all-in price if you're paying double what you should? And just, again, have that conversation, because a lot of customers think that fixed all-in is A, the only product out there, but B, it can also save them money. And unfortunately, we're seeing a trade there. So passing through costs can work to the customer's benefit. It can also work to their detriment. Every customer is different, and with those larger customer sets, particularly in competitive situations, having these conversations around which costs you should pass through, which you should try to manage creatively, and which you should just fix forever is definitely a conversation that you should have, and we can help you have in terms of recommendations to make to the customers. We are happy to analyze, make recommendations, and negotiate specific contract language so that there's no surprises over the term, and we're really optimizing the treatment and the cost on each individual component. So looking at the ways that we do that, like we were talking about at the top of the show, we have our own internal models, we have our own internal feeds with respect to futures. We have built tools where we can now look at the strip and trading history over, over periods of time, look at where it was, look at where it is today, and make some really strategic recommendations in terms of, okay, yes, it's time to go, or no, let's go ahead and hold out a little bit longer. And backing all of that up with data, with these resources, and with actual market intel, as opposed to a gut feeling or a crystal ball. Scott, anything you want to say on our to fix or not to fix and more strategic treatment, or do we want to get into our very strategic managed piece? I saw we have a slide on that, which is great.
I think it's yeah. Well, I know we're getting we had a lot to discuss today. We only got 5 minutes left in the webinar, but yeah, just real quickly again, is just on this. These are the kind of things too that is when we have a questionnaire, we kind of like to know kind of when we're looking at strategically how to work on a deal. It's important to understand what they're currently in and what they're currently if that because competitive wise, it's important to bring something different to the table. And we can spin this as like, hey, yeah, this is a great way to do it this time, or it might be a different way next time. It just depends on kind of how to figure a way in there. And these are the kind of things to kind of bring up to the customer, like, hey, you're kind of on the wrong product. And you should consider this, and this is why. Versus, yeah, I'm currently getting fixed from X. Can you give me pricing for this too, and I compare it to what I'm getting them, the same product? And how often do you win those? You don't. So often, and that's where we're coming. We're going to help you increase your percentage rate in that. So let's go on to the. Oops. There we are. Hedge slide. I'll just go into this real quickly, Allie. I'll get a quick little. Yeah, so we do this managed portfolio strategy. We talked about it before, and for certain customers, this is just a sample. Hedge one, for instance, would be like now example. We'd hedge 62.5 for 2026. Let's say the contract starts in January 26, right? And we'll do 50%. It's load following, right? So we'll load following hedges. The goal is to get to 100% hedges, and for this specific customer. And then you're going to see 2029, they have 8 different spots that the customer has bought in that market. And we'll just be adding on years when it's time for 2030, which should probably be in a year later, a year from now, we add on 2030, we start doing that. We've got many of our larger customers are on this. I would say all of our customers over 20,000 megawatt hours a year, pretty much 90% of them are on this sort of product. They love it. There's a strategy involved. You see there's risk diversification, there's flexibility, reduce the impact of market prediction. This is the big one. And this is a strategy that I deployed and was taught when managing around a portfolio of generators for not just selling them off, but also how to buy the fuel for them, and also how it's basically, economics 101 for things like cocoa buyers, for truck companies buying cocoa, to airlines that bought jet fuel this way. It's just a standard diversification, kind of a strategy, and we bring this to the next level, and we actually bring it down a level too. So really, any customers that are under or over about 3,000 to 4,000 megawatt hours a year, we can utilize this strategy. And
for smaller than that too, I wanted to say just
different sort of strategy in the hedging.
This is something that is definitely for that 20,000 or 3,000, 4,000, but smaller customers, really most customers for which you can get a custom price. So I mean, I'm I was looking at one that was at, it was a single meter, but it was, half a million the other day. And it's, below our threshold, but we're working strategically with this customer. They're on the smaller side, and they were asking about fixing partial energy. And so for that one, we can just do a two-step, maybe we just do 50-50 and we say, okay, let's fix half and float half. And if you hate floating half, then be back and we can flip the other half to fix too. That's that's okay. These don't necessarily have to get as complex as this. Smaller customers do still have an option to participate. Again, we're going to do it in a way that makes sense, but talk to your accountant.
That's a good point. Yeah, for a sophisticated strategy like this, we're talking 4,000 megawatt hours a year kind of stuff, potentially. But there are plenty of suppliers that will do 1,000 megawatt hours a year on a more simple strategy at 50%. How do you want to do that or 50% later on? So yeah, great point on that. Questions? There's a few in here. I'm just going to take one of these again because we're running kind of late. We had a lot of information this month. It's good stuff. Hopefully everybody gleaned some info from this. But we'll answer the other questions. We'll answer them and send out answers via email. Somebody asked here about coal and how they read an article that coal generation's back, and what's that going to do with pricing and there's still coal generation. I don't think there's going to be many plants there where people are going to. First of all, nobody's going to build a new one, and there's not going to be many plants, even though they're just going to be like, yeah, let's mothball, take this out, do this, do that, get it up and running. And so coal is uneconomical versus gas anyway. Still, it's more expensive to run. So at this point, it has ability as a peaker plant, maybe shave a little bit off. Maybe it stops somebody. Something going to happen. Some of these decisions have already been made. I don't see it having as big of an impact as the headline was from reading it. So that's answer to that. So we'll answer the other ones via email. But thank you guys for. I just want to thank you guys, Ellie and myself, for the continued partnership we have with all you, and hopefully some new ones with some new people on the call here. And we'd like to just keep the conversation going and keep growing, helping you grow your business and being really kind of one of the best consultants out there in the marketplace for your business, and you're able to grow it and be successful, have a successful career. But thank you guys. See you next month.
Thanks, guys.